the idea that we would keep hiking until inflation gets to 2%, it would be a prescription of going way past the target. That's clearly not the appropriate way to think about it. So, in effect, if you look at our forecasts, the median participant, and again, these are forecasting out years, so take them with a grain of salt, but people are cutting rates next year because the federal funds rate is at a restrictive level now. So if we see inflation coming down credibly, sustainably, then we don't need to be at a restrictive level anymore. We can move back to a neutral level, and then below a neutral level at a certain point. I think we of course would be very careful about that. We'd really want to be sure that inflation is coming down in a sustainable level. And it's hard to make. I'm not going to try to make a numerical assessment of when and where that would be, but that's the way I would think about it. Is you'd stop raising long before you got to 2% inflation, and you'd start cutting before you got to 2% inflation too, because we don't see ourselves getting to 2% inflation until all the way back to 2 until 2025 or so. So, any numerical guidance around that? I'm saying we'd be comfortable cutting rates when we're comfortable cutting rates, and that won't be this year, I don't think. It would be, but many people wrote down rate cuts for next year. I think the median was several for next year, and that's just going to be a judgment that we have to make then, a full year from now, and it'll be about how confident we are that inflation is in fact coming down to our 2% goal. Rate growth, right? We're looking for supply and demand through the economy coming into better balance, including in particular in the labor market. We'll be looking at inflation. We'll be asking ourselves, does this whole collection of data, do we assess it as suggesting that we need to raise rates further? And if we make that conclusion, then we will go ahead and raise rates. So that's how we're thinking about the next meeting, and how we're thinking about meetings going forward potentially. But we're now mainly thinking about the next meeting. I will also say, since we're talking about it, between now and the September meeting, we get 2 more job reports, 2 more CPI reports. I think we have an ECI report coming later this week, which is Employment Compensation Index, and lots of data on economic activity. All of that information is going to inform our decision as we go into that meeting. I would say it is certainly possible that we would raise funds again at the September meeting if the data warrant it. And I would also say it's possible that we would choose to hold steady at that meeting. We're going to be making careful assessments, as I said, meeting by meeting. And I'll close by saying we've raised the federal funds rate now by 525 basis points since March 2022. Monetary policy, we believe, is restrictive and is putting downward pressure on economic activity and inflation.
So if you're data dependent, why not pause again? Why not stay on hold? Why not take another meeting off when the data was at least cutting in the direction you want to see?
So if you go back to what we're trying to do here, we're trying to achieve a stance of policy that's sufficiently restrictive to bring inflation down to 2%. At the last meeting, we wrote down our individual estimates of what that would take, and the median of that was an additional 2 rate hikes. So I would say we looked at the intermeeting data, and as I mentioned, broadly consistent. Not perfectly consistent, but broadly consistent with expectations. And as a result, we went ahead and took another step. And that's a labor market that continues to be strong, but gradually slowing. I mentioned that the inflation report was actually a little better than expected, but we're going to be careful about taking too much signal from a single reading. And growth came in stronger than expected. So that's how we look at it, and so we did take that step today. It has been my view consistently that we do have a shot, and my base case is that we will be able to achieve inflation moving back down to our target without the kind of really significant downturn that results in high levels of job losses that we've seen in many past instances of tightening that look like ours. That's been my view. That's still my view, and I think that's sort of consistent with what I see today. So, but it's a long way from assured, and we have a lot left to go to see that happen. So the staff now has a noticeable slowdown in growth starting later this year in the forecast. But given the resilience of the economy recently, they are no longer forecasting a recession. I just want to note that that our staff produces its own forecast, which is independent of the forecast that we, as FOMC participants, produce. Having an independent staff forecast as well as the individual participant forecasts, is really a strength of our process. There's just a lot of I think constructive diversity of opinion that helps us make informs our deliberations, helps us make I hope better decisions. We have a job assigned to us by Congress to get inflation under control, and we think the single most important thing we can do to benefit those very families, especially families at the lower end of the income spectrum, is to get inflation sustainably under control and restore price stability. We think that is the most important thing we can do now, and we're determined to do that. And I would just point out that the people who are the most hurt by inflation right away are people who are on a low fixed income, who, when you're talking about travel or transportation costs, heating costs, clothing, food, things like that, those, if you're just making it through each month on your paycheck and prices go up, you're in trouble right away. Even middle-class people have some resources and can absorb inflation. The people in the lower end of the income spectrum have a harder time doing that. So we need to get this done, and the record is clear that if we take too long or if we don't succeed, that the pain will only be greater. So that's how I would explain what we're doing. Banking sector profits generally are coming in strong this quarter, and overall the banking system remains strong and resilient. Of course, we're still watching the situation carefully and monitoring conditions in the banking sector. In terms of the actual effect on, if you think of a particular set of banks that were affected because of their size and business model and things like that were more affected by the turmoil in March than others, it's very hard, as I mentioned, it's very hard to sort of tease out the effects on this very large economy of ours from them tightening. They may be tightening a little bit more, probably are, than other banks. The SLOOS has been telling us for more than a year that banking conditions are tightening. That process is ongoing, and that will restrain economic growth. So I think we have to take a step back from. I can't separate those anymore. I think basically we're just looking at the overall picture, which is one of tightening credit conditions, and that's going to restrain economic activity. It is restraining economic activity. So that's how I would look. We are watching it, of course, very closely. And you're right. The withdrawal from the Black Sea Grain Initiative does raise concerns about global food security, particularly for poorer countries that import a large share of their food. Grain prices did go up on this news, but they remain well below their peaks of last spring. And the moves that we've seen so far, I would say, are not expected to make a significant contribution to U.S. inflation. Of course, we will be watching that situation carefully.
So you don't think it would have a big effect on Fed policy at this point?
You wouldn't say so, looking at what we know now. Existing homes, there are many people who have low-rate mortgages, and whereas they might want to sell in a normal situation, they're not going to because they have so much value in their mortgage, which means that supply of existing homes is really, really tight, which is keeping prices up. On the other hand, there's a lot of supply coming online now, and there are people coming in. A lot of the buyers are first-time buyers coming in at buying it, with these relatively elevated mortgage rates. But I think this will take some time to work through. Hopefully more supply comes online, and we work through it. We're still living through the aftermath of the pandemic.
Welcome to the Crypto Teacher. And I come back with that video just to make you think.
Don't forget to like and subscribe to the channel.
And guys, we had Jerome in the house. And the Fed raises another 25 basis points. And guys, we know it was not needed. But it definitely was a sign for you to get in the lab. Because this 25 basis point hike just speeds up the fourth industrial revolution. Remember what Klaus stated. We live in a fragmented world. Remember, they have to destroy this current legacy market so the digital transformation can happen. And what's scary is that Jerome did not tell us the truth. Also, Jerome Powell was just reading off a script. Now we have the bond market expecting the Fed to cut rates at the end of the year or starting next year. And Jerome Powell stated he doesn't expect to get to that 2% inflation until 2025. And guys, we know with rates this high, we're going to get there a whole lot sooner. We see the American economy crumbling. And he states there will be no recession. Guys, we know we're already in a recession. All you have to do is go to the Fed's website. We see credit card debt keeps moving up. Delinquencies keep moving up. American families being crushed at the grocery store. And guys, we know core inflation hasn't went anywhere. Why? Because it's corporate greed. Remember, a handful of companies own everything. It's an illusion of choice. And Jerome Powell admitted that credit is already tightening. So if credit is tightening, small business won't be able to move. I know where I'm at. Small businesses are closing left and right. And these big high-rise commercial buildings are completely empty. And Jerome Powell talks about housing. And guys, we know when it comes to housing, it's all about supply and demand. And we know the Fed squeezed us doing the C word and squeezing it again because nobody wants to move with these high rates. But guys, do not forget the mission. Remember in the fourth industrial revolution, they don't want you to own anything, but they say you're going to be happy. And guys, we know we hear those drums are beating. He talks about Russia, Black Sea, and the grain cutoff. And we know that's going to affect the globe. If you're able to grow your own food, grow everything possible. And remember the crypto teacher told you. Because when those drums get beating louder, we know they're going to come up with an event. The main event is going to put people back in their homes. They've already done the test. So we know what the metaverse is for, and we know what UBI is for. Because they want the robots, algorithms, and drones to run the economy, and they're going to convince you to stay at home and stay safe while you're inside the metaverse. Getting free programmable money, telling you what, where, and when and how to buy, and you have 3 to 6 months to spend it, or poof, it's gone. And then when you are let outside, you only get to go 15 minutes away. And remember the crypto teacher told you, because he knows. When it comes to the New World Order, it's all planned out. You have a wonderful day.
Good afternoon. My colleagues and I remain squarely focused on our dual mandate to promote maximum employment and stable prices for the American people. We understand the hardship that high inflation is causing, and we remain strongly committed to bringing inflation back down to our 2% goal. Price stability is the responsibility of the Federal Reserve. Without price stability, the economy doesn't work for anyone. In particular, without price stability, we will not achieve a sustained period of strong labor market conditions that benefit all. Since early last year, the FOMC has significantly tightened the stance of monetary policy. Today, we took another step by raising our policy interest rate 0.25 percentage point, and we are continuing to reduce our securities holdings at a brisk pace. We've covered a lot of ground, and the full effects of our tightening have yet to be felt. Looking ahead, we will continue to take a data-dependent approach in determining the extent of additional policy firming that may be appropriate. I'll have more to say about monetary policy after briefly reviewing economic developments. Recent indicators suggest that economic activity has been expanding at a moderate pace. Growth in consumer spending appears to have slowed from earlier in the year. Although activity in the housing sector has picked up somewhat, it remains well below levels of a year ago, largely reflecting higher mortgage rates. And higher interest rates and slower output growth also appear to be weighing on business fixed investment. The labor market remains very tight. Over the past 3 months, job gains averaged 244,000 jobs per month, a pace below that seen earlier in the year, but still a strong pace. The unemployment rate remains low at 3.6%. There are some continuing signs that supply and demand in the labor market are coming into better balance. The labor force participation rate has moved up since last year, particularly for individuals aged 25 to 54 years. Nominal wage growth has shown some signs of easing, and job vacancies have declined so far this year. While the jobs to workers gap has narrowed, labor demand still substantially exceeds the supply of available workers. Inflation remains well above our longer run goal of 2%. Over the 12 months ending in May, total PCE prices rose 3.8%. Excluding the volatile food and energy categories, core PCE prices rose 4.6%. In June, the 12-month change in the Consumer Price Index, or CPI, came in at 3.0%, and the change in the core CPI was 4.8%. Inflation has moderated somewhat since the middle of last year. Nonetheless, the process of getting inflation back down to 2% has a long way to go. Despite elevated inflation, longer-term inflation expectations appear to remain well anchored, as reflected in a broad range of surveys of households, businesses, and forecasters, as well as measures from financial markets. The Fed's monetary policy actions are guided by our mandate to promote maximum employment and stable prices for the American people. My colleagues and I are acutely aware that high inflation imposes significant hardship as it erodes purchasing power, especially for those least able to meet the higher cost of essentials like food, housing, and transportation. We're highly attentive to the risks that high inflation poses to both sides of our mandate, and we are strongly committed to returning to inflation to our 2% objective. At today's meeting, the committee raised the target range for the federal funds rate by a quarter percentage point, bringing the target range to 5.25% to 5.5%. We are also continuing the process of significantly reducing our securities holdings. With today's action, we've raised our policy rate by 5.25 percentage points since early last year. We have been seeing the effects of our policy tightening on demand in the most interest rate sensitive sectors of the economy, particularly housing and investment. It will take time, however, for the full effects of our ongoing monetary restraint to be realized, especially on inflation. In addition, the economy is facing headwinds from tighter credit conditions for households and businesses, which are likely to weigh on economic activity, hiring, and inflation. In determining the extent of additional policy firming that may be appropriate to return inflation to 2% over time, the committee will take into account the cumulative tightening of monetary policy, the lags with which monetary policy affects economic activity and inflation, and economic and financial developments. We will continue to make our decisions meeting by meeting based on the totality of the incoming data and their implications for the outlook for economic activity and inflation, as well as the balance of risks. We remain committed to bringing inflation back to our 2% goal and to keeping longer-term inflation expectations well anchored. Reducing inflation is likely to require a period of below-trend growth and some softening of labor market conditions. Restoring price stability is essential to set the stage for achieving maximum employment and stable prices over the longer run. To conclude, we understand that our actions affect communities, families, and businesses across the country. Everything we do is in service to our public mission. We at the Fed will do everything we can to achieve our maximum employment and price stability goals. Going to a different economy, and we're going to be learning more about that as we go, but clearly we're learning that things can be done from remote locations. We're learning that technology can replace people even more than we thought.
We're not going back to the same economy. We're recovering, but to a different economy, and it'll be one that is more leveraged to technology. And I worry that that is going to make it even more difficult than it was for many workers.
In Silicon Valley, and my friends who work in technology know that what we did to the manufacturing workers, we are now going to do to the retail workers, the call center workers, the fast food workers, the truck drivers, and then even bookkeepers, accountants, insurance agents, lawyers, and on through the economy. So what happened to the manufacturing workers is a very clear sign.
And so we'll import Chinese-based CBDC technology. So it's going to be CBDC in a box provided to you by the People's Bank of China.
But every stock, every bond, every currency, every commodity, every piece of art, every private business, every piece of real estate will eventually be a token on a blockchain, an entry on a ledger, permanent and immutable. We will have truth instead of trust, and we will save over $7 trillion a year. 6 to 8% of global GDP is wasted by the friction of the trust industry that's necessary when you have dual entry accounting. With triple entry accounting, which is what a blockchain is, we get rid of all of that friction. It's a beautiful future.
Like what you see in China and their social credit scoring systems, right? If we get identity wrong, it could be a tool to enslave humanity. And if we get it right, it could be a tool to liberate humanity. And as an American, I'm obviously rooting for the one that's on the side of freedom.
Bitcoin is an international asset. And also, I do believe the role of crypto is it's digitizing gold.
I actually believe this technology is going to be very important. Look at it. We have been part of a huge revolution in investing through ETFs. We believe that ETFs will be changing the whole way we invest. Many people still use it as a means, well, people are investing it for indexing. No, the majority of people who are putting money in in ETFs are active investors that are buying exposure. The entire bond market is being transformed as we talk right now. I believe the next generation for markets, the next generation for securities will be tokenization of securities. And if we could have that distributed ledger that we know every beneficial owner, every beneficial seller, we all have our code of who's buying, who's selling, instantaneous settlement. And think about it, it changes the whole ecosystem.
Crypto Teacher and the New World Order book, plus the 3 kids books. It's time to re-educate. Also, new to cryptos, Coinbase, Bitrue, Binance. Do not forget book links and crypto links are in the description. The stock channel, guys. Don't forget to go like, subscribe, spread everywhere. You have your Kobo, your chip stocks, your banking, your gaming. While everybody's sitting at home, get on stocks, the Seaver, the biotech stocks. And while everybody's at home wishing, they were still getting that free money. What are they doing? Drinking and smoking weed. Don't forget about those stocks and you have a wonderful day. The most powerful person in the world is the storyteller. The storyteller sets the vision, values, and agenda of an entire generation to come. Steve Jobs. And guys, you know I truly believe in this. When you look at the New World Order, they're the storytellers. And that's the reason why I wrote my New World Order book. But guys, now it's time to change the current generation. And I wrote 3 kids books. You know I love the Trinity because I understand the power that's in it. So I have 3 books. We have an opportunity to change the generation, to educate. Not just me, but I want to show you that I take action on a daily basis. And I want you to take action on a daily basis. Whether it's your job, whether it's in your community, we have an opportunity right now to educate the masses. I posted this on my Twitter account. Please share, but this is a short clip of the 3 books. There's going to be a clothing line and action figures. Please get these books for your kids, nephews, cousins, friends, so therefore we can start the re-education now. Because as we see, the 4th Industrial Revolution foundation is definitely here. Robots, algorithms, drones, taking humanity out the picture. We have to re-educate. But let's get into the video.
Part 1. King Joshua and Grandma Tam save the village. Part 2. King Joshua and Grandma Tam save New York from COVID-33. Part 3. King Joshua and Grandma Tam goes to China.
It's mandatory to get part 1, part 2, and part 3 of this series. It's time to re-educate Generation Z.